Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
You're a savvy investor, so you've likely taken the time to determine the appropriate asset allocation for your portfolio based on your risk tolerance and financial goals. Once you've initially set up your portfolio, regularly rebalancing your portfolio is a critical part of maintaining a portfolio that aligns with your values. And that is the topic today for the College Investor Audio Show. Welcome. So let's take a look at what is portfolio rebalancing. I know when you first hear the term portfolio rebalancing, you might conjure up an image of an intricate financial balancing act. And that assumption is really not too far from reality. Portfolio rebalancing is the act of reorganizing your asset allocation as your portfolio grows. Although it would be ideal if your portfolio could rebalance on its own, that's just not a possibility without the help of a robo-advisor or target date fund. So let's say you determine that your ideal investment portfolio consists of the following: 25% large cap, 25% international markets, 25% REITs, and 25% intermediate bonds. It can be tempting to set up your portfolio and just forget about it, but market fluctuations will inevitably throw your ideal asset allocation way out of whack. For example, you might glance at your portfolio 12 months later to find that your portfolio now consists of the following: 10% large cap, 30% international markets, 50% REITs, and 20% intermediate bonds. At this point, you'll need to take the time to rebalance your portfolio. Otherwise, your investments may not push you closer to your original financial goals. Unfortunately, it can be all too easy to just forget about your portfolio rebalancing for years. When you finally realize what is happening, you might find that your investment trajectory is dramatically off course. Don't do that. So why should you rebalance your portfolio? You know, when you set up an investment portfolio, it's just good practice to choose a mix of assets that will propel you towards your financial goals. In fact, asset allocation is often considered the most important part of an investment portfolio. Without taking the time to determine which asset mix will protect your portfolio goals and reflect your risk tolerance, you might end up running into some big issues with your portfolio along the way. So, for example, you may find that your portfolio includes more risk than you're comfortable with. And if you need help thinking through your asset allocation decisions, just take advantage of our free guide. We have that up for you at thecollegeinvestor.com. But what happens after you find the right mix for your situation and set up your investment portfolio? Unfortunately, your portfolio can be thrown off based on fluctuation in the markets. It's just what happens. Market fluctuations are completely normal. They still can seriously affect the asset mix in your portfolio and push your investment goals off course. So it might help to think of rebalancing as a choice made to stay on course you've set yourself up for. If you never rebalance your portfolio, you might be staring into uncharted territory, as if you were a driver that decided to throw out the map while on a cross-country road trip. Although you continue to drive in the same general direction, just go west. You could likely find a more efficient route to your destination if you made an effort to stick with your intended course. If you went through the time to create an asset allocation mix that works for your financial goals, then you should absolutely take the time to regularly rebalance your investment portfolio. Otherwise, you're going to be missing out on the chance to maintain a portfolio that is designed to suit your personal financial goals. Here's how to rebalance your portfolio. Rebalancing is a key part of building an investment portfolio that lasts. So as you move forward, there are 3 different options that could work for your situation. Take the time to decide which option will work best for you and set up a system to regularly rebalance your portfolio. DIY portfolio rebalancing can feel a bit daunting, but it's absolutely possible to rebalance your portfolio by yourself. If you choose to rebalance your portfolio yourself, Excel and Personal Capital are a few tools that can really help you out. You'll need to check in with your portfolio at least once a year to ensure that your portfolio stays on track. It's important to note that a DIY portfolio rebalance can be a somewhat tedious process. This is especially true if you have multiple investment accounts. If you want to give portfolio rebalancing a try, take a closer look at our full article that's posted at thecollegeinvestor.com. Just type in the word portfolio rebalancing, you'll find it. A robo-advisor, portfolio rebalancing. This can make the process of rebalancing a breeze. With the right robo-advisor, you can skip the process of sorting through your investments. Instead, you can just set up a plan that provides parameters for your ideal asset allocation. With that information, a robo-advisor can follow through on the details for you. If you want to take advantage of this easier rebalancing opportunity, we got a few of the best robo-advisors that can help you out. Betterment. And it's not just robots running the show. You also have access to humans too when you choose to work with Betterment. M1 Finance. We love it. It's the #1 robo-advisor for DIY investors. You can just let this app handle rebalancing for you. Wealthfront. If you have a high net worth, Wealthfront could be the best option for your rebalancing needs. Those are just a few of our favorite robo-advisors. If you want to rebalance regularly without the hassle, then take some time to find the best robo-advisor for your situation. Don't worry, we have plenty of links and resources at thecollegeinvestor.com all about robo-advising. Now, you can also do target date funds with built-in rebalancing. If you want the best of both worlds, target date funds could be the right solution for your rebalancing needs. Although you won't have to work with a robo-advisor, you also won't have to dive into the nitty-gritty details of rebalancing constantly. A target date fund is based on your expected retirement date. Essentially, the fund will rebalance itself to match the appropriate risk for your age. This can provide a happy medium for investors that are comfortable investing in ETFs. Here's the bottom line. Rebalancing is an important component of an investment portfolio that is successful in the long term. Luckily, you can choose to implement regular rebalancing into your wealth-building strategy. Just take some time to consider your rebalancing options and then choose a strategy that aligns best with your investment preferences. And you can find all those tips, hints, and tricks to having an amazing portfolio that suits your needs at thecollegeinvestor.com, and tons of reviews on robo-advisors, all kinds of stuff there too. Again, it's thecollegeinvestor.com. And that's all we have for you today. Thanks so much for stopping by. I hope it was helpful, and we'll talk to you again real soon.